Now central banks are the most powerful institutions you were never taught to question. They don't make headlines often. They rarely face elections. And most people can't explain what they actually do. But central banks control the price of your money, the fate of your economy, and the value of everything you have worked for. They can create wealth out of thin air or erase it overnight. And the strangest part, they don't really answer to you. This is the story of how central banks came to rule modern finance, not as neutral referees but as active players in a game they helped invent. It is a story of hidden power, financial engineering, and the illusion of stability. And once you understand how it all started, you'll never see your paycheck, your debt, or your savings the same way again. Let's go back to 1694. England was broke. The crown had just fought an expensive war against France and the treasury was empty. It wasn't a bank like we think of today. It didn't exist to serve citizens. It existed to fund the government and profit from doing so. That is the origin of the modern central bank, not as a stabilizer but as a lender to the state. And over time that power only grew. By the 19th century, central banks across Europe had adopted similar models. Privately owned institutions with special privileges. They issued currency. They controlled reserves. They bailed out governments in crisis. And in return they gained extraordinary influence, often without democratic oversight. In the United States the story took a rockier path. Americans were deeply skeptical of centralized financial power. The first and second banks of the United States were both shut down after political battles over corruption and elitism. For much of the 19th century the U.S. had no central bank and the financial system was a wild mess of private currencies, speculative manias, and violent panics. But after the Panic of 1907, a crisis so severe that private financier J.P. Morgan had to coordinate a rescue himself, pressure mounted. In 1913 Congress passed the Federal Reserve Act, creating the Federal Reserve System. It was pitched as a decentralized network of regional banks that would stabilize the economy. In practice it became a central authority with immense power over interest rates, credit, and money supply. And here's where the story gets darker. The Federal Reserve isn't a government agency. It is an independent entity with public and private elements. Its board is appointed by the president, but its member banks are privately owned. It is funded not by taxes but by interest on government debt and the fees it charges banks. It operates in the shadows of financial markets, making decisions that affect millions without any voter input. So who does it serve? Officially the Fed has a dual mandate: maximum employment and stable prices. Unofficially its actions often benefit the same institutions it was meant to regulate. During the 2008 crisis the Fed didn't just cut rates. It created trillions. It rescued investment banks. It propped up asset prices. It guaranteed toxic debt. In 2020 it did it again. Buying corporate bonds, pumping liquidity into markets, inflating asset bubbles that made the rich richer while everyone else was told to wait for trickle down. This is the deeper truth. Central banks don't just control the economy, they shape it. They choose winners and losers. When they cut rates, stocks rise. When they tighten, markets crash. When they print money, asset holders get rich. When they raise rates, the working class pays more for mortgages, credit cards, and loans. Today we live in a world where central banks are more powerful than ever. And more unaccountable than ever. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England. These institutions are not neutral. They are the architects of our monetary reality. Since 2008 they transformed the economy into something barely recognizable. Low interest rates became the norm. Quantitative easing, a once unthinkable policy, became routine. Central banks created trillions to buy government bonds, corporate debt, mortgage securities. Asset prices soared. Stocks, real estate, commodities. For those who owned assets it was a golden age. For everyone else it was inflation disguised as prosperity. Housing became unaffordable. The stock market detached from wages. Savings earned nothing. And most people had no idea why. They blamed politicians, immigrants, bad luck. But not the invisible hand guiding the money supply. The modern financial system is designed to keep you in motion. Not to set you free. Central banks reward debt. They punish saving. They manipulate rates, control narratives, and move trillions with a keystroke. And every intervention is sold as stability. But it is not your stability they protect. It is the system, the banks, the asset holders, the machine. In 2020 markets collapsed at record speed. Within weeks, central banks injected massive liquidity. Stocks rebounded. Billionaires doubled their wealth. Workers lost jobs. Small businesses died. Renters faced eviction. What was saved was not the economy. It was the illusion of strength. And the cycle of dependency deepened. When central banks distort the cost of money, they distort everything. Risk becomes impossible to measure. Saving becomes harder. Retirement becomes uncertain. Bubbles inflate. Crashes follow. And real wealth becomes harder to build while paper wealth evaporates overnight. Most people never realize the interest rate on their student loan, the return on their savings, the price of their home all come from decisions made in rooms they will never enter by people they will never vote for. Central banks will save the system. They always do. But who saves you?